Okay, here we have problem 5-10. And the problem says in 2011, Falls City began to improve certain streets via bond issue that was supplemented by a federal grant. The estimated total cost is 4 million. 2.5 million was coming from the bond issue and the balance from the grant, from the feds. Capital projects funds used to account for the project. The street account was designated as the street improvement fund. So in this case, it's talking about like you can, if you're talking about funds, there's not just something called a capital improvements fund where all of the capital improvements for a city go. There are kind of separate pots for a specific project. So the street improvement fund is considered one capital improvements fund. The municipal airport fund for the same city would be a separate capital improvements fund. So anyway, the following transactions occurred in 2011. All right, so here we go. We're just recording all these and we're recording them at the government-wide level also. So if we look here, we got a trial balance, blah, 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 and I've already kind of filled it out, okay? Because I felt like I was wasting too much of my time on y'all's videos and your time by typing and scrolling and stuff like that, okay? So let's do this here. Let's go here and split the screen so that we can kind of see our problems while we're doing our entry. So this first one, it's easy. Issued $100,000 6% note bond anticipation notes. So in the capital projects fund, we're recording the receipt of cash, and in the government wide entry, the government activities journal, we're also receiving cash. But this is one of our differences, right? This is considered revenue in the capital projects fund, other financing sources. But in the government-wide journal, the government activities, it's considered a payable, bond anticipation notes payable. So there's your two differences there. Here's where we're recording our grant. The federal grant was recorded as a receivable. Half the grant is to be paid in 2011 and the remainder of 2012. And the grantor specified that the portion to be received in 2012 was not available for use until 2012 because there's no, guarantee that the government's going to renew and appropriate the 2012 portion. Okay, so we can only record this as available in the current year. So we're debiting our receivable account. So like when we recognized that this was going to be available during 2011, and just revenues. Sometimes there might be a specific revenue account like a government grant revenue. Like is the case here in the government-wide journal, it's a grant revenue is the account and due from the federal government, just like in the capital projects fund entry is your receivable. Okay. Number 3, keyword here, a contract was let to Apple Construction. That means whenever you see that or whenever you see a purchase order was signed, we're talking about encumbrances. Okay, we hadn't received the invoice yet, but we just have to set aside a part of the fund balance for this purpose. Okay, so this is how we're doing that here is to record the 2.7 million as an encumbrance and the reserve for the encumbrances in the street improvement fund, which is a fund balance account, right? So you see the fund balance nature of it. It sets aside, and this is the ending balance after, but it sets aside part of this fund balance for you to be able to see how the fund balance is carved up among the uses for the funds. Okay. So we're recording that 2.7 million here as an encumbrance. There is nothing, since this is like a budgetary type entry, kind of a reserve entry. It doesn't appear in the government-wide statements. The next one, let's see, 60,000. An invoice received from the City Stores and Services Fund for supplies to the Street Improvement Fund of 60,000. The net amount had not been encumbered, so there's no need to reverse the encumbrance or reserve for encumbrance that you recorded back up here. There's no need to reverse any part of it. So they are to be capitalized. The costs are to be capitalized. So you see here, you're not capitalizing anything. It's an expenditure in the capital projects fund, construction expenditures. That's kind of the end number that all these transactions are going to kind of work their way through to is construction expenditures. Due to other funds, this is not like a vouchers payable. It's a separate type of a payable account that's just for the when you're having transactions between other funds in the same government. This case, here's where, again, where you're starting to see the differences between capital projects and the government-wide. The government-wide governmental activities journal looks almost just like a for-profit business. You are capitalizing the 60,000 as a debit. It's not an expenditure account, it's a work in progress account, which we make heavy use of in our not-for-profit world. We manage real estate. We have lots of projects that go across fiscal year ends, so larger projects. So yes, that's an asset account. You'll see in the next problem, number 5, similar treatment. You've got construction expenditures and cash. When we are, this one is cash because it's saying that preliminary planning costs were paid to the Mid-Atlantic Engineering Company. And these weren't encumbered previously either. These are kind of some little small startup expenses, and then you'll see the bigger transactions hit in a moment. So we're paying this right off the bat. We're paying this capitalized government-wide amount, and we're capitalizing it. We're paying it in cash there. Number 6. Number 6 says a vouchers payable was recorded for $18,500 from the local telephone company for underground properties. All right, so we are again construction work in progress for the government-wide journal and construction expenditures for the capital project. Same thing. This time it's saying we are only recording. We've only received the invoice so far. We're not paying it yet. So that's why it's vouchers payable. All right. So number 7, an invoice in the amount of $1 million was received from Apple for progress. The invoice is consistent, and a liability was recorded. All right. So here's where we can start to reverse part of the encumbrance in the reserve for encumbrance that we recorded earlier. The reserve, remember, is kind of the fund balance type account. So we're debiting that for $1 million, and we're crediting encumbrances to both, if you'll remember, to reduce those amounts so we're reducing the amount of the reserve here because we're officially converting that into, and you won't see it here. Hold on, I'll let you see it. Let me just do this. What number are we on? Number 7? Yeah, let me do this. Watch. Let me just delete all these, and then I'll just press the undo button. Hope I'm not doing something risky here. All right, so yeah, see how I just close it? So we're taking part of that 2.7 million and it's becoming if we had already paid it, if we had already received the bond proceeds, we would be taking it out of here on cash. But as of right now, it's just a payable. So you're essentially, part of that transaction that we just did is shifting this 2.7 million. We're officially kind of shifting $1 million of that to payables and out of that reserve for encumbrances because we're about to pay the bills. Okay. And we are, as part of this $1 million transaction, we're recording construction expenditure, right? Because it's invoiced, it's ready to go, it's been incurred. Oh, let me press undo before I forget that. And then again, on the government-wide side, we are crediting contracts payable, but then debiting construction work in progress, not construction expenditures like we are. It's not an expense in the government-wide side. All right, so here we go. We're getting our cash in. Here's the cash we're reporting. Due from the federal government, we got the $750 from the federal government that we already recorded earlier, that we already accrued earlier, so we can kill that one now. The $750 is offsetting this $750 debit. And the other financing sources, proceeds of bonds. That is now, and it was at par, so you don't have to worry about the premium and the discount and all that kind of stuff and the differences between government-wide and governmental capital projects fund like you did on the previous problem. But this one is pretty cut and dried. It's just 2.5 million as other financing sources versus when you're doing the government-wide entry, you're recording that as bonds payable. Okay, so that one's easy. 3.25 million in cash recorded. The bond anticipation notes that they issued while they're waiting on their bond proceeds to come in, they were repaid. That's so from number one, remember we issued those $100,000, 6% bond anticipation notes that are to be repaid from the bonds in 180 days. So since we know we're going to have to, without even scrolling back down here, 100,000, we're going to have to record our interest expenditure as part of this bond payoff. So let's do this note payoff. I'm sorry. 1, 2, 3 times 0.06 times 0.5, since we're doing 180 days out of 360 for half a year. So we'll do 0.5. And so our interest expenses should be 3,000. Yeah, here we go. So since this is, we recorded that the bond anticipation note is other financing sources. So when it's going back out the door, when we're repaying it, it's going to be a debit to expenditures. And then 3,000 to interest expenditures and 103,000 total credit to cash to pay off that note and the related interest. And here we have in the government-wide governmental activities journal, the same thing, except we're paying off a payable instead of recording an expenditure like we are in the capital projects fund. Oh wait, did I just skip number 8? Oh no, we did 8. And number 9 we just did. So 10 is the amount billed by the contractor less 5% of retainage was paid. Okay, so this is going to look a little weird, but it's like they have a separate payable account for the retained percentage, which is probably smart. It's like where you can set aside all of your payables that you're only holding because of the retained percentage term in your contract with them. And so once that retained percentage is met, like once the punch list is cleared out, then you can just pay that entire account, no matter. So we're going to debit the entire $1 million, get it out of contracts payable, and we're going to pay most of it, 95% of it, with a $950,000 credit to cash, but we're holding back 5% of it. So we've credited this contracts payable retained percentage liability for the 50,000. So we'll pay that 50,000 later. Same thing on the government wide side. The entry looks exactly the same because we recorded this contracts payable earlier in both places. Number 11, we're buying CDs or some type of temporary investment, maybe in one of these cash mutual funds that Regions, that our bank Regions offers for kind of overnight investment. Those are kind of out of style now because interest rates are just absolutely unbelievably low. We have to kind of sometimes go looking for a little more yield and take on a little more risk because it's so bad. But anyway, so we're buying the investments, we're debiting that, we're crediting cash. On the city assignment, the Corvallis Smithville, this one seems to trip up people a lot. For some reason, I'll get trial balances that'll have like a credit balance for investments of 3 million and cash will be too high by 3 million. So I'm not sure, kind of what's going on there, but just be sure you're, when you're recording an investment, when you're investing in something, whether it's CDs, you're debiting it and you're crediting your cash in order to invest in it. When that investment matures, you'll be debiting cash again because you're getting your money back, and you'll be crediting the investment unless you're rolling it over or something like that. So anyway, those two entries, capital projects fund and the government wide, look almost identical. They are identical. Same thing. You'll notice that too. Anytime you're talking about kind of movement between assets or assets and liabilities, as long as it's not crossing over into the kind of the expenditure and income world, then the entries are going to look the same. So when you're paying off a payable or you're recording an investment, or you're recording the maturity of an investment. A lot of those are going to look the same as the government wide, but when you start getting into revenues, expenditures, debt, capital assets, those are the big drivers of the differences. Okay. Revenues. All right. So this number 12 is we're closing out. All right. So let's do this. Let me see if I can filter by this that I've already typed so that we can see both. Oh, I know. Yeah. First of all, it's filter by this. Filter selected cells by value. All right. So good. So it's just got our closing entry there. And now let's get rid of this split, because we don't, we just know we're recording closing entries. So yeah, closing entries, all you're doing is looking at your pre-closing balance on the trial balance. If you're doing your, the Corvallis workbook or the Smithfield workbook or the city, whatever the city workbook is, you are, you're just going down your pre-closing balance and just entering the opposite. So you got a credit balance for revenue, 750. That means you need to debit it. Same thing, other financing sources, and other financing sources, proceeds of bonds. You're going to debit all of your expenditures, debit all your various expenditures, blah, blah, blah. So, so you're doing all that, and it's all closing out to, including encumbrances, right? Because you recorded this encumbrance this year, but it's really just kind of setting aside and that reserve's not going anywhere. That reserve's staying there. So you've got a reserve and a fund balance here that are going to be your end result of your only remaining accounts, kind of from the income statement side of things. I realize those are on the balance sheet, but that's where you're closing things to, and you're closing your encumbrances back to fund balance, because in this case, you want to make sure you have that held out there, because you've got these big, you've got this big 1.8 million here that is already kind of spoken for, right? It's spoken for because you've already signed the contract for 2.5 million to build the. So just to try to tie that all together and make a little more sense, okay? And so you're crediting all your expenditures, enters, and then here is your entry to fund balance here, okay? Is kind of your plug for this entry. So I hope this was helpful.